Investors, for the most part, so far, the fourth quarter 2024 S&P 500 stock index performance and the third quarter 2024 earnings season has been off to the races in a positive way. You've heard about the historic seasonality of the U.S. stocks, with September and first half of October being some of the worst historic time periods of the year. This, coupled with many investors' concerns over the upcoming presidential election here in the U.S., kept many investors on the sidelines waiting for a better entry. I know a few investors who went all to cash at the beginning of 2024, trying to avoid the stock markets altogether. Take a look at the table from Bloomberg showing the monthly returns and seasonality in the S&P 500 since 2009. If you went to cash early in 2024, you've likely missed most, if not all, of the over 20% year-to-date gains in the S&P 500 index. If you were scared off in late July and early August during the normally weak time period, this year's excuse being the yen carry trade implosion and short-term volatility spike and hedge fund delevering, you've likely missed the recent 8% plus rally to new all-time highs in the S&P 500. The weak September many equity strategists called for didn't happen, and it seems to have been pulled forward into the 4 weeks of late July and early August. However, as one can see by this table, those losses occurred intra-month, and all of the summer months netted positive S&P 500 index gains. Other investors listening to the doomers, including the likes of Robert Prechter and Elliot wave theorists over a year ago in October 2023, never got back into the markets because they convinced themselves that a replay of 1987 was at hand, we were at the beginning of a crash, or worse yet, they were looking to call a generational top in U.S. stocks and forever cement their reputations as legendary market soothsayers. We debunked those analogies way back then and were advising investors that that was likely a major buying pivot. Many market strategists have thrown up alarm warnings for most of the year, warning of stock market risk around the election. The work our team has done throughout the year has said much of this risk in the market that others have been warning of that have kept many investors from investing and enjoying some, if not all, of 2024's 20% plus year-to-date index gains had most likely been priced in already. And 2024 would likely turn out to be a very normal and good year for the markets. We've noted the same things since the year started. What's that? It's that almost everyone is already nervous and hedged with the same time frame in sight. Investors, we're in the home stretch of 2024, and many are still sitting and watching, waiting for the other shoe to drop, waiting for the presidential election, waiting on the end of the Ukraine-Russian war, waiting for peace in the Middle East, waiting on volatility to subside, which, as I've repeatedly noted for the last 2 months, already has and is likely to continue. Many investors are waiting on China economy to rebound, waiting on the U.S. consumer to collapse. I can go on and on and on with this list. And so far, quarter to date, what has mattered? What has mattered is our economy continues to grow at a moderate pace. Inflation continues to cool at a moderate pace, and the overall earnings in the U.S. economy continue to grow, and those stocks are rewarded positively. A quick recap of the earnings quarter to date have been rewarded. Bank stocks like JP Morgan, Morgan Stanley, Charles Schwab, and Goldman Sachs, not to mention a few other large financials like BlackRock, the world's largest investment manager, and Travelers Insurance. Consumer communication and discretionary stocks like Netflix and cruise line companies have already reported better than expected subscribers or passengers and healthier margins. Industrial companies like Fastenal and Snap-on Tools beat modest expectations for growth, and their stocks jumped substantially. The negative reports and stock price actions so far have been minimal. The main culprit widely missing their outlook was ASML Lithography, the number one manufacturer of optical equipment for semiconductor manufacturing. That was caused by a dramatic slowdown in their China sales on the back of regulations holding back Chinese demand. That was the main culprit. But Intel's financial situation also played a role there. In the healthcare space, Medicare and Medicaid insurance providers missed badly as most of their new enrollees since COVID-19 have upped their service usage, and these insurers are taking big hits to their margins by way of higher medical loss ratios. One other area of weakness, many energy companies have given weaker guidance on the back of low oil prices and slower China demand. However, energy stocks account for less than 4% of the overall S&P 500 index. The upside standout in the healthcare space was ISRG Surgical, which is the #1 player in the robotic surgery procedure market. New tool sales globally, as well as higher utilization of their installed tools and higher consumable sales, led to a massive earnings and margin beat, and the stock made substantial new all-time highs last week. By the time this video airs, almost 50% of the S&P 500 will have reported earnings, and we will be within 2 weeks of the presidential election. Many investors are sidelines, waiting on volatility to decline. Folks, it's already has in the markets themselves. Take a look at the updated chart of realized volatility, that's RVol, which is actually happening in the markets. Actual 30-day trailing volatility in the S&P 500 has declined to under 9 as of this video. Volatility futures for the weeks following the election in mid-November, take a look at that chart. It was 18.3 as of this writing, almost 115% premium to actual volatility. I've repeatedly said throughout 2024 that I thought anytime volatility futures rose to 20 to 22, sellers would come into those markets and buyers in the S&P 500 would show up. That's nearly exactly what's transpired. Take a look at the shorter term chart of the December volatility future. This contract is tradable and expires about 5 to 6 weeks after the election. During the time period that if there is any delay in results, we're likely to finally find out what the vote count is. If this was a stock, most technicians would say it's a sell the rally, it's an upward channel that has been pierced, and it's starting to look like a trend reversal lower. Lower future implied volatility has historically led to pressure stock prices higher, not lower over the weeks and months ahead. I found over the last 20 years of investing that while never perfect, nothing in investing is, it's very, very, very rare for the market makers who traffic in forward volatility markets, the volatility insurance salesmen, I call them, to misprice future market risks outside of black swan events like COVID-19 pandemics or other unpredictable events. In fact, if anything, my work says most of the hedges around the election will expire worthless and cause market participants to cover higher, or at least pressure stock prices higher for longer in the fourth quarter of 2024 through early 2025. Investors, we're in the home stretch for the election as well as 2024 stock market returns, and they both argue for higher for longer into 2025 inaugural parties for whichever candidate might win. Do politics matter when it comes to equity investing? I've argued for the last 3 elections, not as much as you think. The ultimate issue is what is the economy doing? What are earnings doing? What's the Fed doing? And then what is going on in DC? Even when it comes to presidential and political policies, it's rare, but be it tax rates, energy regulation, or tariffs, sometimes they have the opposite outcomes versus expectations. Earnings and earnings growth are far more important than who's sitting in the Oval Office. Yes, political policies can make or break certain sectors or industries, but overall, as political strategist James Carville said in 1992, it's the economy, stupid.
Well, the politicians say one thing and they do another. And the 92 campaign, as I recall, was pretty specific. It was called Putting People First. I think there was a sign that said, it's the economy, stupid.
First and foremost, when it comes to stocks and your investment returns. If you're uncomfortable with a wider range of possible equity outcomes, the Oak Harvest team has launched a new strategy that retains the ability to go long stocks, short stocks, as well as buy partial hedges and shock absorbers for your portfolio. Information on this new strategy of ours can be found at oakharvestfunds.com. From myself, from Charles, from James, from Chris and Dwayne in Atlanta, and from Eric behind the camera, have a great weekend.